All right, my good people, it is that time again. We're on episode 7 of the free game web series. What is it called? How to Hunt. All right. This episode is going to be a little bit detailed, a little bit nitty gritty, basically looking at a fund, and I'm showing you what to look for, which will help you make a purchase. And even though we're discussing one fund, this translates to any fund, any stock, pretty much anything. This information translates. So I'm teaching you how to hunt. We're looking at a mutual fund. We're gonna go a bit of a deep dive, right? So remember I said in the first video, we're gonna go macro and a micro level. This is a bit of a micro level, okay? Micro level event. Here we go, episode 7. Let's go! Shout out to the oh so lovely ladies of Alpha Kappa Alpha Sorority Incorporated. Anyway, all right, so the ticker symbol for what we're talking about is FXAIX. It's a Fidelity index fund. Remember we talked about mutual funds, index fund stocks, okay? We're talking about a index fund. All right? So, what is the index fund? Basically, a quick recap. So remember I gave the talk about the mall, right? Say there's 1,000 stores in the mall. One store in the mall is one stock. A group of stores in the mall is a mutual fund, and buying the entire mall is like purchasing an index fund. That's what we're talking about. Why do that? Because of diversification. You want to be diversified in case something doesn't do as well. Another store can lift it and still do better. It's well diversified. It's going to protect you, right? You want to be protected somewhat. So the ticker symbol is FXAIX. I'm going to attach a picture of everything we're talking about. So you can pull it up and follow along, or you can go online and pull up this information as well. Again, just Google that ticker symbol, or you can go to fidelity.com because this is a fund through Fidelity. And you can pull it up and we're going to go through this information. So here we go. How to hunt. All right. So what we're going to look at, the first thing when you're looking at a fund, basically what you want to get an idea of is, or any stock or any fund is, what's the rating, right? Again, this isn't the only information you need to make a decision on a stock, but it just helps guide you, right? So Morningstar is a rating agency, right? It's sort of a company that looks at stocks and bonds and everything, and they sort of give them a rating. So basically, generally speaking, the higher the rating, the better it is, right? It goes on a rating of 5 stars. So 1 is the worst, 5 is the best. So this fund is actually rated as a 4-star, okay? You're going to see that the returns are a little bit above average, okay? And the expenses are low, which means, so again, you want expenses. So the way these companies make their money, part of that is by having expenses, or basically what they charge you to purchase or to maintain and manage the account. That's how they make their money. They have to make their money somehow. But these numbers are generally typically small in terms of the overall account, but we'll get into that in a later talk. So the expenses are low. The returns are somewhat high. There's about 4 blocks out of the 5, which means it's pretty good. And then you see a section where it says risk of the category, right? The higher the risk, the greater the reward, right? The higher the risk, again, you have an increased chance of losing your money. But again, that's relative. That's a relative thing, okay? Now we're going to get to the performance. This is the key. This is what I want you to look at whenever you're evaluating to make any purchase on a stock or anything. You want to look at the performance, okay? So as of right now, today is January the 7th. I don't know when I'm going to post this video, so I'm going to post it soon, but today is January the 7th. The year to date on this year is negative 0.19, right? That's bad. Now, we're going to we're going to look at the 1 year. So 1 year ago, if you would have made this purchase and continue purchasing throughout until 1 year later, you would have earned 18.4% on your money. Okay. Now the next column says 3 years, right? So if you would have purchased 3 years ago and continued to put money into the account, you would have earned 14% over that time period. Again, this is very important. You're not getting this in a bank. You're not getting this in a savings account, right? It's not happening, right? Now let's look at 5 years. 5 years, 15.21%. So you would have earned 15% compounded interest over time if you would have invested in this 5 years ago. Look at the 10-year number, 13.87%. All right. Now, this is the key. We're going to look at the amount that this fund has returned since its inception, meaning when did this mutual fund start? When did it first become available for you to purchase it? That was in February 17th of 1988. So that's when this fund started. From February the 17th of 1988, if you would have purchased this fund, you would have earned, from then until now, you would have earned 10.7% on your money since 1988. All right. Now think about what's happened since 1988. There's been several stock market crashes, right? There's been a lot of things that's happened, a lot of ups and downs, right? But again, remember what I told you. Every time it goes down, it comes back up. So again, if you would have invested $250 per month since February 17th of 1988 until today, you would have put in $96,000 of your own personal money, but the value of the account would be $895,837. Now, the compounded interest that you would have made would have been $799,587. That's your money working for you, right? Simply by putting that money into the account and watching it grow over time, with the market crashes, with the housing crisis of 2008, with the dot-com bubble crash of 2000, the sluggish market performance in the early 2000s, all of that combined, if you would have stuck with it, not taking anything out, continued to stay the course, that's how much you would have right now, 32 years later. Generational wealth. This is it, okay? This is it. This is it. This is it. All right, so now we're going to go down a little bit further and talk about some of these other numbers. You're going to see a number that says NAV, N-A-V. That's the net asset value. Basically, it's a fancy term for that's how much it's going to cost you to basically buy one share. But don't even get caught up in the number of shares of the mutual fund, right? Think about it in terms of overall dollars. $250, $100, a 10% return on $100 is $10. Think about it like that. 10% return on $1,000 is $100. Again, I'm not good with math off the top of my head, so if that's a little off, forgive me. But again, so this is important. Now, you see another number that says the 12-month low and high. All that basically is for the past 12 months, the lowest price this has been was $77. Most likely when the crash happened last February when COVID first happened or something like that. And the highest it's been was $130. So that's the range that you could have purchased it at over that time period. Again, that's just what it talks about. Now we're going to look at the holdings, okay? So remember when I said an index fund is like it's a snapshot of buying a little bit of the top 500 companies or something like that in the index 500. So basically, the top 10 holdings is going to tell you what exactly is in the fund because you're buying companies. That's all you're doing. You're buying shares of companies via the mutual fund. So the top 10 holdings or the top 10 companies in this mutual fund in terms of the percentage are as follows. And you're going to be able to see this. Apple, Microsoft, Amazon, Facebook, Alphabet, Berkshire Hathaway, which is Warren Buffett, Johnson & Johnson, Procter & Gamble, and Visa. Right? Those are the top 10 holdings. But you can go down and look at all 500 holdings of the mutual fund. So again, it's well diversified, right? It's well diversified. That's why, and again, and this can change as the fund goes. They can make changes to it whatsoever. But again, it's well diversified. Since the inception of this fund, it's yielded almost 11% return. For the past 10 years, it's yielded 13.87%. For the past 5 years, 15%, and for the past year, 18.4%. All right. This is how you hunt. So now your homework is going to be simple, right? You did this. You looked at it for a mutual fund. Pull up any company, any other mutual fund. Just Google anything randomly and look at the same information I told you. That's it. And it's going to help you and it's going to paint the picture. And then you decide what you want to buy. That is it. It is literally that simple, right? I said the first video I said, I want to make this information easy to digest so that it'll take away the fear and allow you to act sooner in terms of making a decision, because time is money, right? Compounding interest depends on time, meaning the longer your money is in, the more money it makes for you. So if you wait for a year from now, you've lost a year of compounding interest. All right, so this is episode 7, how to hunt. I basically showed you the basics. That's it. Now, again, it can get more detailed, but again, you don't have to know all of that stuff to just understand the basic concepts of this, right? You don't have to know 10,000 details. I'm still learning every day. I learn something new every day when I research, right? Just because you don't know everything doesn't mean you can't start, because you're going to learn along the way, right? As you start to invest and you start to see these companies and learn what they're about, and you start watching a few shows on TV, you're going to pick it up and learn very quickly. Like, oh, that's what that means. Oh, well, if the government does this, that's why this company did that. Or, oh, wow, this company decided to do this year and they earned this amount. Oh, wow. Or they expanded and this happened. You're going to start to put it together in your mind, and it's going to paint that picture. You're going to understand. You're going to understand, right? People make jokes about, Jeff Bezos and all these guys, the value of Amazon going through the roof this past year. Why did it go through the roof? Right? Stimulus money. People started buying more stuff off Amazon. It's simple. That's why. All right. So why not take a part of this? Get involved in it. Episode 7. How to hunt. Get started. Homework. Look up 2 or 3 mutual funds, index funds, stocks, whatever, and look at that same information I told you, and it'll help you make your decision. All right. Game is free. This one sold separately.